Right, as we continue with how to identify applicable ratios, the next category, what you need to look out for, if they ask you to comment on issue price of shares, or they can say buyback price, that we also call repurchase price, right? Here we're talking of what? Price of shares. So if you see price there, they want you to comment on buyback price, issue price, repurchase price. The first indicator is the NAV, the net asset value. This is your net asset value, right? That's the first indicator that you look at. Now, your net asset value shows you the actual value of assets, actual value of shares, right? This is according to the balance sheet, right? So when you look at the NAV, you're actually looking at the actual value of the shares. Now, and then the second one is the JSE Market Price. So the market price, this is the investor price on the stock market. Okay, so what we are saying is that a share can have two kinds of price. It can have a price based on its value, which is the net asset value, or it can have a price based on what investors are willing to pay. So now let's say they're asking you to comment on issue price, and they tell you that the issue price was 10 rands, and then the NAV is 12, and then the market price is 15. So it's very simple. What you then do is that you're going to say the issue price of 10 rand is below the actual value of the shares of 12 and below what investors are willing to pay on the JSE of 15. What it means is that from the perspective of a shareholder, I would not be happy because the company is being shortchanged in that if the shares had been sold at their actual value, they would get 2 rands more per share. If the shares had been sold on the JSE, they would get 5 rands more than the price at which the shares were eventually sold. So this scenario here is good for this scenario here, I can tell, is good for the investor. In other words, the one who is buying, the buyer. But this scenario is bad for the company or the existing what? The existing owners. Why? Because we're saying the company could actually get more by selling on the JSE. The company could actually get more by selling the shares at their actual value than what it was sold for. But the investor who is buying would be happy because they're buying shares at a discounted price. Okay? Now, let's say it's the buyback. Now, you're going to see that there's a difference. Let's say this price is a buyback price. Let's say I want to use exactly the same figure so that you see the difference. So the buyback price is 10, the NAV is 12, and then the market price is 15. So what it means here is that the business is the one that's buying back the shares here. So the business is the one that's buying back the shares. So the business is paying 10 rand for shares whose actual value is 12. Which shares if they are sold on the JSE, they will fetch 15 rand. So what it means is that it's good for the company. Why? Because they are buying shares at a cheaper price. This is bad for the seller because they're getting less than the actual value of the shares. So what it then means that when you're commenting on this, you take your issue price, compare with the actual value, compare with the JSE price. You take the buyback price, compare with the actual value, compare with the market price. Right now, what is the difference between the two? The NAV represents the actual value of the shares according to the balance sheet of the company, and then the market price represents the price that investors are willing to pay on the JSE. I just gave examples here. You're going to see when you look at question papers, it doesn't mean that the MP is always going to be above the NAV and above the issue price. No, it can be either or, but you will see that as we deal with question papers in other videos that are coming.